Well, finally today, the cost of housing is going down. No, it's not going down because of prices. It's going down because rates are coming down. So what exactly is happening? Well, unless you've been under a rock, you realize today the CPI number, the inflation numbers on the consumer side, dropped substantially. Where were they? Well, they were 9% just about 2 years ago. So in 2022, the inflation numbers hit 9.1%. Would they come in at today? 3%. I want to show you guys a nice little caption right through here. CNBC interviewed this young man. He's from Lennar. Great content here. When he's done, I'm going to try to answer that question for everybody is once the Federal Reserve does all they do, by the end of the year and they drop rates maybe 1 or 3 times, what's that going to do for mortgage rates? So check out this video. When we're done, I'll give you my take on what the long-term plans are for mortgage rates. So take it away, CNBC.
Joining us here at Post 9 today, Lazard's chief market strategist Ron Temple is back. We're grateful, Ron. Good to see you again. You think September's appropriate? You're not pressing for July? Right?
I think July should be a consideration, but let's be honest, it's not going to happen. I mean, if you look at the markets are pricing a 95% chance now of a September rate cut, up from about 70% yesterday. I think what's going to be important to see on July 31st is how Jay Powell telegraphs the rate cut. I mean, he's already opened the door in his congressional testimony this week, talking about the dual mandate and softening in employment. Now it's really time for the Fed to recalibrate and make sure that they think about both of their mandates, full employment and price stability, not just price stability.
That said, you don't think a cut will necessarily reflect economic weakness, just better trends in inflation, right?
It's primarily, if I could say it's like an 80-20, right? And maybe 80% of it is disinflation. If you look at the last quarter, headline inflation at a 1.1% run rate, core at 2.1%. Some elements of that are not going to be sustained, so I think that's, a bit of a head fake in the positive direction after the first quarter was much worse than expected. The other 20%, though, is there are signs of economic weakening. Look at job creation. First quarter, 267,000 jobs per month. Second quarter, 177. Number of open jobs per unemployed person down from 2 to 1.2. Quit rate down from 3% to 2.2. So there's a lot of data coming.
So he's going through a lot of the jobs numbers. And the reason why I stopped it right here is I want to show you guys the shelter inflation piece of this number. Okay, it's over there. It's 5.2%. Why that's important is because that makes up 40% of this CPI number, the consumer inflation numbers. That's going to play a key role in me explaining a lot of things after the fact. So let's get back to it.
Coming in saying there's softening in the economy, not so extensively that I would say recession's a risk, but that we just go from very strong growth to strong growth.
So could they go in July?
Again, low probability. I mean, if I were sitting on the Fed, I would be advocating for July 31st. Again, they've described their policy as being restrictive, and there's no longer a need to be as restrictive as they are. But I think September is the date when they start. And then maybe the bigger call is, do they cut at each meeting and through year end? I think they do. The market is saying 60 basis points of rate cuts by year end. I think we get 75.
You do. So you see cutting all through the fall?
Yes.
And then what? I mean, what is the path here? Yeah. Where are we going?
Well, I'm glad you asked that. That's really important because, again, if I'm right that this is because of disinflation and softening of strong growth but not weak growth, then the case would be that the Fed would cut rates to maybe 3.5% to 4% over the easing cycle, but that's it. So I don't think people in the market should be pinning their hat on a 2.5% Fed funds. And if I'm right, that means the 10-year Treasury yield probably should not go down from here. In fact, maybe it should be a bit higher. So, I don't think we're going to get a whole yield curve moving down. I think you're going to get a steepening where the short end comes down, the long end stays where it is, or maybe even goes up, especially given that regardless of who wins the presidency, we got 6% of GDP deficits as far as the eye can see, and at some point that's going to affect the long end of the curve.
So what would that do to those who have hopes for lower rates vis-a-vis housing, for example?
Moneyball question.
That's definitely a frustrating area because, you've got mortgage rates even today right around 7%. This has squeezed a lot of first-time homebuyers. Interestingly, pre-GFC, the median age of a first-time homebuyer in the U.S. was 29 years old. Now it's 36 to 38. So I don't think that's going to get a lot better anytime soon.
Is it enough to unlock some of the capital markets activity, say, that you guys have been waiting patiently for at Lazard?
I do think this does provide better opportunities. I think it's going to draw cash off the sidelines. It should be great in terms of the IPO market, maybe some more activity in terms of some other kind of strategic acquisitions. I do think it's a positive on that side.
And then finally, you still like the AI trade.
We'll leave it at that because then they start talking about other investments and so forth. But here was the key point. Remember when I was showing you that the shelter inflation numbers was 5.3? This is a big question mark when it comes to these numbers. So if you go to Barron's, here's what they have. They said right through here, rent growth at a unadjusted rate at 5.1. Remember the chart said 5.3. Okay, so that's number one. There's a little bit of discrepancy there. Here's the biggest discrepancy, and I know I'm going to get a ton of feedback down below saying Zillow, they don't know what they're talking about. It's fraud or whatever. But Zillow's coming in saying this number is 3.5%. Okay, so why is that important? Well, because that number, the shelter number, or the housing number, makes up 40% of the CPI number. So it is really effective. Is it currently at 5.1? Is it 5.3 or is it 3.5? We'll never know this. But at least what we're seeing right now is rates are starting to moderate. So now what we want to talk about is where are rates going to go from here? So let's take his information from this and say, okay, the Federal Reserve starts to cut. They cut 3 times, but the 10-year Treasury doesn't move. So what does that mean for mortgage rates? Let's see what this is, down more than an eighth. Okay, the market's starting to correct a little bit, but that's a big run we have so far today. So here's what's my expectations are on this. The long-term rates for mortgages are usually this. Usually you could take the 10-year Treasury and add between 1.5 and 1.75 to this yield, and that would be your mortgage rates. Okay, so if you did that right now, it'd be 4.2. Let's say it's plus 175. So we'd be at 6%. Okay, so we'd be at 6%. That's where I'm expecting mortgage rates to get to. Okay, and once all the uncertainties around things, especially the Federal Reserve, starts to come in check, you're going to start seeing mortgage rates come down. Are they going to get back down to 3, 4, 5%? I don't think so. I think our threshold right now is going to be within the next 6 months or so. We're going to see rates about 6%. That should open some floodgates up because just remember, in last October, rates were 8. So this is starting to give us a little reprieve. So far right now in the bond market, the 10-year Treasury, it's actually down quite a bit. But we focus here on is the mortgage-backed security bond. Why? Well, you're watching the rate update with Dan Frio. So I talk about mortgages and real estate and everything else. This is what's going on in the MBS market right now. The MBSs are up 26 points. So that means rates are gonna, should come off about an eighth. Well, they did come off an eighth. Okay, so that's where we are right through here. So we're at 6.85 on the 30-year rates right now. These are the top 6 programs people use when they're buying their first house. So just so you guys understand these rates, I want to make sure you understand these rates. They're not mine. They're not any individual bank's rates. What these rates consist of are basically 5 questions. Mortgage News Daily surveys lenders all over the country, and they ask them these 5 questions. If you had somebody looking to buy their first house, it was going to be their primary home and a single family home. Those are important. Okay, those are 3 of the 5 factors. The other 2 factors are right through here. You're putting down 25% because you have a 75% loan to value and you have a credit score, a FICO mortgage credit score of 780. Okay, well, that's what your rate would be. If that's not your rate, you're trying to figure out, okay, Dan, I'm looking to, I got a 720 credit score. I got a 680 credit score. What do I qualify for? Maybe an FHA loan is better for me. Don't try to qualify yourself or don't disqualify yourself. How do you figure all this out? Well, visit me. My name is Dan Frio. I'm a licensed loan officer in all 50 states as well as Puerto Rico. I'm also one of the country's largest mortgage brokers. So what a lot of people say is when you're trying to get pre-approved for a house, what you do is you call 5, 6, 7 different banks. Everybody approves you and then gives you a rate quote. I wonder if you could do that with one application and one credit pull. What we do here is we put your application in, we run your credit, we get you approved through Fannie Mae and Freddie Mac. If you don't understand that, check out some of my other videos that I talk about. Then what we can do is we can offer you rates from our bank as well as about 44 different banks that we're working with right now. So we can give you a quote. Basically, we'll get you a quote from all 44 companies. We're going to pick out the best one for you and send that to you. Okay, you use our services to take care of this whole transaction for you. Instead of you having to apply at every different bank, having your credit pulled, dealing with all different loan officers, you can deal with one application and one credit pool. How do you do it? We'll go to the rateupdate.com and here's your starting point. Step 1 would be basically put in your application. But before you do anything, check right here. We got grants up there. This is a grant finder that's going to help you find to see if you're eligible for any grants. But if you're like, hey, Dan, Can I call you guys? Can I email you? Oh, yeah, you can do either of those. Scroll down to the bottom of the rate update, and there's our phone numbers. There's our 800-844. Well, let me rephrase that. That didn't sound right. Our 800 number is 844-775-5626, or you can reach me at dan@therateupdate.com. Thanks so much for watching, guys. This was the closing bell. I hope you join me back tomorrow to see what the producer inflations come back in is tomorrow. And if that number comes in even better than we saw today, the markets are in for a good rally. Take care, folks. See you tomorrow.